Risk is the possibility that a negative financial outcome that matters to you might occur. It is impossible to avoid risk altogether. The challenge for you is to have a reasonably balanced approach to all the risk you face, and that starts with understanding your own risk tolerance and financial goals. Let's look at a few key concepts you need to understand when it comes to risk. First, risk comes in all different flavors. How easy or hard it is to cash out of an investment when you need to is called liquidity risk. Your investment value might rise or fall because of market conditions. That's called market risk. If you own an international investment, events within that country can affect your investment. Political risk and currency risk, to name two. And that's just scratching the surface. Essentially, every asset class comes with its own set of risks that you need to take into consideration. That's where our second concept comes into play: risk-reward ratio. The level of risk associated with a particular investment or asset class typically correlates with the level of return the investment might achieve. The rationale behind this relationship is that investors willing to take on risky investments and potentially lose money should be rewarded for their risk. Let's look at an example of this. You're least likely to lose money investing in CDs, but you will get much less return than investing in stocks. Historically, stocks have enjoyed the most robust average annual returns over the long term, just over 10% per year, followed by corporate bonds, around 6% annually. However, it is not always the case that stocks outperform bonds, or that bonds are lower risk than stocks. Their returns and risk levels can vary depending on prevailing market and economic conditions. That brings us to averages and volatility. Even if you hold a broad, diversified portfolio of stocks, such as the S&P 500, for an extended period of time, there is no guarantee that they will earn a rate of return equal to the long-term historical average. The timing of both the purchase and sale of an investment are key to your investment return, along with fees. You might have heard the saying, buy low and sell high. The reality is that many investors do just the opposite. If you buy a stock or stock mutual fund when the market is hot and prices are high, you will have greater losses if the price drops compared to an investor who bought at a lower price. That means your average annualized returns will be less than theirs, and it will take you longer to recover.